Hello and welcome to this first module of my security token class. What this class aims to do is get you up to speed on what are securities, what are security tokens, why are they an opportunity. In this module in particular, we're going to talk about securities and security law and how that fits in with what we're trying to accomplish with security tokens. Hopefully by the end of this module, you'll have a better understanding of why security tokens are an opportunity and what exactly they are looking to tokenize, where exactly the opportunity is. In the next module, I want to talk more about security token exchanges and the platforms that security tokens are going to be based on. This is really getting into the depths of what the security token infrastructure, the security token ecosystem is going to look like. And this will give you a better idea of where exactly the opportunities lie in this space, because what we'll find is that the security token space is not as friendly or as open as the ICO space was, but there's intent behind that. And so I'll teach you what you need to be looking for as an investor so that regardless of your situation, you have a massive opportunity in front of you. And finally, in the last module, we're going to talk about some predictions and some abstraction based on our current circumstances and what the security token space is going to look like in the future. In essence, I aim to sum up what is the opportunity, what the world will look like after widespread security tokenization. But returning back to this module, what we're going to discuss is the origins of securities and how we can determine what qualifies as security. We're going to talk about why certain things, such as collectibles, are not classified as securities. We're going to talk about the purpose behind securities laws. That will help us understand what is the benefit of tokenizing the security and why you want to fractionalize property ownership. We're going to talk about how tokenization unlocks liquidity, how security tokenization will look different based on whether it's a public or private company. We're going to talk about why the security token space is very different than the blockchain cryptocurrency space, because centralization within the security token space is pretty unavoidable, but it doesn't erode the value of these systems. And finally, we'll also clear up some major misconceptions about security tokens, such as they're not valuable because security tokens are representing assets which are not digital, and why you don't need security tokens if you already have a highly efficient database. So with that, let's dig into this first class. There's a lot to go over, and I hope this is a really good learning opportunity for you. So just like blockchain, I think when we squint our eyes and look towards the horizon and explore how the world might change in the aftermath of what we're working on today, very few things get me as excited as security tokens. Hopefully, if you're listening to this video, you understand how Bitcoin and blockchain work from a high level, and you understand that they are digitizing cash, a monetary transfer system. It's going to take some time, but I think ultimately they will be successful in usurping the fiat currencies which currently rule the world. But the thing to note is that only 30% of the world's wealth is in cash. Far more is held as property and securities. So before we address that, let's quickly talk about the two different kinds of tokens you'll see out there. On one hand, you're probably familiar with the utility token. A utility token is a quote-unquote coin backed up by a project. It is the type of investment I think most of the people listening to this video are going to be used to. This is essentially what an ICO is going to issue during their initial coin offering. Usually utility tokens are based on the Ethereum standard or going to be launched on several other major cryptocurrency platforms out there, such as EOS, Neo, and Stellar. The big advent with utility tokens, and rather the blockchain platforms out there, is that they allowed people to build and launch blockchain projects without having to build a blockchain by themselves. Ethereum in particular lowered the barrier so much that we saw thousands of projects launched within the course of 2016 and 2017. Now, typically when someone invests in a utility token, there's an expectation of some definable benefit. Most commonly what ICOs would do is position their utility token as access to a particular system, or it would work as the de facto currency for some sort of access to a service. For example, paying developers or accessing some sort of cloud service storage. The easiest way to think about a utility token is as an arcade token. In its purest form, it's not meant to appreciate in value. All it's meant to do is represent value within the system that they've built. You don't go to an arcade hoping to make returns on your investment into these arcade tokens. They're simply there to be used within the system so that you can access the services, the arcade machines. But here we have the major problem with the utility tokens. Many ICOs disguise their intentions with their utility tokens and hope to make returns based on the tokens that they issued. This is why the US SEC has declared that most ICOs that they've seen are indeed securities. So let's address that. What is a security? As it relates to the US, the Securities Act of 1933 and then the Securities and Exchange Act of 1934 draw the line very clearly when it comes to overseeing securities laws. It's pretty telling that for nearly 100 years, we've used the same standards to dictate what is a security. The crux of these securities laws is something known as the Howey test. The Howey test has 4 filters or questions that test the security or non-security in question by asking, is there an investment of money? Is the money being contributed to a common enterprise? Does that common enterprise rely upon the work of others? And finally, the 4th and most important question is there an expectation of profits? Now, the thing to know is that the vast majority of securities are privately held. One of the easiest ways to understand a security is to look at the example of Kickstarter. If you don't know what Kickstarter is, it's a fundraising platform where you as an investor look at projects that are asking for money and you potentially give money to that campaign. They might have a fundraising goal of say $1 million, and if they can achieve that goal, then they should be able to make their project a reality. Now, when you invest in that project, you don't have an explicit expectation of profits. You're not expecting the $100 that you give them to be $200 by the time the project launches. Your expectation is that you're going to receive access to whatever service or physical good that they're building, and there might be some sort of incentive structure built in, such as a reduced price of the good that they're building, or getting access to the game that they're building first. But the important point to note is that this is not a security because there's no expectation of profits. Now, returning back to the 4 points of the Howey test, probably a more important way to look at how to derive what is a security is to look at points 3 and 4 and sort of combine them. An expectation of profits predominantly from the efforts of others. This is why things like baseball cards, lottery tickets, rare pieces of art, collectible cars, they're not securities. When you look at these things by themselves, sure, maybe they're an investment of money, maybe your friends pulled your money together and all invested to buy that really expensive, rare car, but if there's no expectation of profits, predominantly from the efforts of others, then that's not a security. Okay, but what if we had a token that represented a baseball card? That by itself would not be a security, but what if you could have fractional ownership of that baseball card and that you believed it would appreciate in value because it's so rare? And what if those tokens that represented fractional ownership of the baseball card were being traded? Would that be a security? Actually, no. The fact that something is a token doesn't change whether or not it's a security. And going back to the Howey test, that's why we know that. The baseball card by itself, nobody is going to argue that that is a security. If you tokenize it, that doesn't change its properties. What really matters is what the agreement is building that token. What is the agreement being built between people? Even if you have a fractionalized ownership token of this baseball card, that alone does not make it a security. Collectibles are allowed. They're not considered securities. You could trade them freely. You could tokenize them and trade them too. There's no reason you can't. Just because something is anticipated to go up in value or be a store of value does not make it a security. What would make it a security is the agreement between people. If you're raising money, if you're crowdfunding money, and the people participating in your campaign think that your work, a person's work, as in the CEO or CFO or COO, are going to do something that will make the shareholder or the investor money, that's a very different thing. For example, if you were to build a token and you advertise it saying, hey, we're going to buy X number of baseball cards and you're going to get a percentage of what we sell. This also helps us understand security law under the lens of real estate. If it's just real estate in of itself, it's not a security. Real estate in general is not a security, but real estate investments can be securitized based on how they're sold. If you, as a developer, go out and raise a bunch of money from a bunch of different people, that's where you're starting to get into securities law. Now, there's many different ways to structure real estate transactions, but most of them are not a security. Securities law is mainly concerned about when somebody is asking somebody else for an investment, and investors believe that investment will return yield based on the efforts of who they're investing in. That's really what it comes down to. Now, there's some caveats, of course. You could have something where you don't depend on anybody's effort, but because of what the investment or instrument is structured as, that becomes a security. For example, if you buy other securities, that makes you a security. If you have an investment that buys securities, or you have something that represents shares in a business or something like that, that is definitely a security. So now we have to answer the question of why? Why do we do this? I mean, sure, we could go back and understand the reasons they set up the Howey test the way they did, what went into the Supreme Court decision that made that a structural component of how we do business in the United States, but I don't think that would answer why we still do securities law nearly 100 years later the same way we did it back in 1934. The answer is that it's a classic principal agent problem. When there is fractional ownership and you entrust your money with someone, be that to invest it or manage it, there's a principal agent problem where the interests aren't aligned exactly. For example, when you give your money to a bank, your interests are that the money be safe and that you might get some interest rates yielding some returns, but the bank has a very different expectation of what it's going to be doing with your money. So securities laws stand in the way of that. They ensure that investors can be protected and that the capital formation process is one that is watched fervently. Securities laws are designed to protect investors like you and I. They're there to ensure and facilitate capital formation. And they also make sure that there's a regulated and orderly secondary market. And make sure that the people that you're entrusting your investment to, the principal agent, that there's some level of disclosure and trust of the third party that you're investing into. Summed up in a single sentence, securities laws were created to prevent fraud and the actions of bad actors dominating the space. We certainly saw that in the ICO market in 2017. We saw people taking other people's money and pulling exit scams. We saw virtually no investor protections in place, which is why the ICO market was often referred to as the Wild West. And that's not a good thing. But one thing I do need to stress is that we also saw projects that were just bad and took people's money without really a hope of how to accomplish their vision or make something happen. So the thing I need to stress is that there is a difference between a scam, a fraud, and a bad idea. Securities laws, regulations are put in place to prevent the former, but they're not there to prevent the latter. And yeah, this is a really hard thing to enforce and make sure of. The best scams are not obvious by definition. So what securities laws try to do is curb market manipulation, prevent outright scams, but they're not there to try and protect an investor from taking a chance on maybe a bad idea. We can see this with how often the federal government lets people lose money and make generally bad investing ideas. You can go to your nearest gas station, pick up some lottery tickets, which are a terrible idea. You could go to a casino where, as we know, the house always wins. Essentially, it's not the government's job to ensure whether or not the investment that you're investing in is good or bad. The government's job, the SEC's job, is to protect you against purely bad actors. Those people that want nothing more than to separate you from your money and give you nothing in return. So let's quickly recap what we just talked about. You have securities laws based on the Howey test. The Howey test is primarily concerned with there being an expectation of profit derived from the work of others. You don't need to try and memorize all 4 points of the Howey test. Simply, when you think about what is a security versus not a security, ask yourself the question, am I investing in this with the expectation that I will get a yield from my investment based on the work of other people? Also remember that governmental organizations like the SEC exist to enforce these rules, to protect the investor, to ensure that the US marketplace is one of fairness and doesn't look like a Wild West or a black market. We may very well see securities laws rewritten within our lifetime, updated to embrace this new digital age. But for the time being, the SEC and governmental organizations like it are there to enforce the rules, not write them. So going back to what we were talking about earlier about utility tokens, in its purest sense, a utility token does not violate securities laws because if it's set up correctly, there's no expectation of profit derived from the work of others. For example, let's look at some common types of coins we see out there. So to better understand what creates the value of a token, we need to ask the two questions of why is the token valuable and what creates that value. Under the first question of why is the token valuable, we either have utility or investment. Under the second question of what creates that value, we have either the network or the issuer. So in the top left, we will identify stablecoins as being valuable because of the investment in them. And what creates that value is the network. Now, with such a high volatility, it's often difficult to use cryptocurrency as a medium of exchange. Merchants can't afford to be paid with a coin that might lose half its value the next day. So stablecoins attempt to solve this problem by pegging their value to some other asset in order to keep their value relatively constant. There are three fundamental mechanisms to design a stablecoin: fiat or some other non-crypto asset collateralized, crypto collateralized, and uncollateralized. Generally, the stablecoins we see in the market are designed under mechanism number one, fiat or non-crypto collateralized. The companies that issue these stablecoins state to have the coin fully collateralized and redeemable. The collateralized fiat currency, be that USD or another fiat currency, are held at a bank or at a trust company's escrow account. The coins are backed by an asset, fiat currency, and their value is derived from this asset. We might also see an example of a gold-backed coin, which falls under the investment and issuer categories. This stablecoin is collateralized by gold that is kept in a vault, and its value is derived from the value of gold. Now, at first glance, you might believe that a fiat collateralized or a gold collateralized stablecoin does not violate the Howey test because, hey, there's no expectation of profit, right? Sure, there's other people working on this coin, but if they're just tokenizing a vault of gold, how is that a security? Well, a centralized company holds the asset in a bank or a vault and issues tokens that represent a claim on the underlying assets. These stablecoins are equivalent to the amount of the underlying asset that they possess. The digital token has value because it represents a claim on another asset with some defined value. For example, if we look at gold, that is an asset that appreciates, and an appreciating asset, by definition, is going to derive profit for the investor. In this case, we have a token that its value is derived from the value of gold and backed by gold, and thus could most likely be considered a security token. I also want to look at the stablecoin mechanism 2, the crypto collateralized. I think Maker's stablecoin DAI is the best example of this because DAI is pegged to the US dollar, but unlike Tether or TrueUSD or any other fiat collateralized stablecoin we saw in the first mechanism, DAI is backed by Ethereum held as collateral in an Ethereum smart contract. So how does it work? The collateral is held in a smart contract, where it can be accessed by paying back the stablecoin debt or can be automatically sold by the contract code if the collateral falls below a certain threshold. So the companies that issue these stablecoins, no matter what approach is used, be that loan, maker-taker, or any other, peg the value of their stablecoin to a fiat currency, most often the USD or Euro. In that sense, mechanisms 1 and 2 are essentially the same. The difference is that in mechanism 2, the companies choose to collateralize the stablecoin using a digital asset, be that cryptocurrency. Even though the collateral is done by a crypto asset, the value of the collateralized asset must represent the fiat currency value of the stablecoin. so long as in this mechanism, the holder of a stablecoin has a claim to an underlying asset, which in this case is a digital asset, and derives its value from that asset pegged to a real asset such as USD, then it is quite likely that this mechanism would also fall under the definition of a security token. Now, the only quadrant of this graph where tokens do not represent securities is the bottom left, where the token is valuable based on its utility, aka it's a utility token, and what creates that value is the network itself. We can see two of the largest cryptocurrencies in that category, Bitcoin and Ethereum. In 2018, we learned why the SEC defines them in this way. Quoting SEC Chairman Jay Clayton, "It's a complicated area because there are two types of crypto assets. Let me try and divide them into two areas. A pure medium of exchange, the one that's most often cited is Bitcoin. As a replacement for currency, that has been determined by most people to not be a security. Then there are tokens, which are used to finance projects. I've been on the record saying that there are very few, there's none that I've seen, tokens that aren't securities. To the extent something is a security, we should regulate it as a security. And our securities regulations are disclosure-based. And people should follow those and provide the information that we require." Essentially, what the SEC's position is on Bitcoin and Ethereum is that they are, by definition, currencies, and they act like them, and they're sufficiently decentralized to the point that no one governing body controls the network. So that's a little complicated, and it's why it's still a little bit controversial for something like Ethereum, but I bet we'll see these clarified in the years to come. So to summarize where we've gotten so far, we understand securities laws and we understand why they are enforced the way that they are. And now we sort of have an understanding of what a utility token is and how it fits into the spectrum of what is and what is not a security. So let's start to talk about what happens when something is a security, aka what is a security token? Now, as we remember, securities and securities laws are put in place because we want to protect investor interests. We want to prevent those bad actors from acting upon and destroying the credibility of the economic system. Securities and security tokens will be subject to more stringent regulation and disclosure requirements. So when we look at a security token, it's basically just a security with an electronic wrapper. And I think where we can best understand why the security token is a revelation is we can look back at the history of development over the past 100 years. Think about if you wanted to send a message to someone using a letter. That would take some time, it would take some cost, and while ultimately the message would be delivered, the advent of email and just electronic communication in general allows you to do the same thing instantaneously and at almost no cost. The content is exactly the same, whether it's an electronic medium or a paper medium. The only difference is that once something is in the electronic medium, it can be faster, cheaper, easier, all by orders of magnitude. Think about other areas where the advent of the digital age has changed things and made them faster or cheaper. And so understanding that is the impetus behind why we aim to tokenize or digitize securities. We can issue them and trade them faster, cheaper, and easier by orders of magnitude. And it opens up a ton of new use cases that we didn't have before. Now, some of you might be saying, hold on a second. In the public markets, this process is already digitized. We do not do IPOs by paper. And that's true. I think one of the big misunderstandings that people have about tokenization and what securities aim to do is that they will not help or offer huge benefits to the public markets. Sure, there are some clerical efficiencies by using blockchain technology. Settlement becomes faster and easier. The cap table management is more accurate. But for public-facing securities today, shares in a company that you might trade on the stock market, we're already pretty efficient. And tokenization does not offer some sort of transformative value. So understand that we're not trying to tokenize stocks because they're already pretty digital. But the big opportunity for us is the tokenization of private security interests. These are, by and large, only on paper today. And worse, there's zero liquidity. So if you want to look at sort of the purpose of security tokens, it's to take some of that liquidity from the public markets and by using technology and this electronic process, bring it to the private sector, the private securities, unlocking huge, tremendous value. So again, I want to make very clear, when we're talking about tokenization, when we're talking about security tokens, they provide incremental, tiny value for publicly traded companies. But the real game changer here is for private companies. And compounding upon that, most of the world's securities are private. I mean, think about it. If the world's primary area of securities are private, and in general, those are done on paper, security tokens aim to open up the door to that and allow global liquidity to touch that area. That's a tremendous opportunity. When you tokenize ownership or the equity of a private company, you get the clerical advantages we talked about using a blockchain. You get better cap table management, and you get freedom from tracking things on paper and the issues that often come about using that method, such as double counting shares. But the real use case, the real transformative value, is unlocking liquidity, which investors value. So let's keep talking about that, because I think it's one of the most interesting things about security tokens. What tokenization does is it brings to the table liquidity. This enables you to lock up the capital, but not the investor. And that is a very big paradigm shift. When you invest in a private company, most private companies lock up both the capital that is being invested in them and the investors. They make it impossible for investors to resell their interest in the business. It's not their fault. That's the way the system is right now. But tokenized securities will allow businesses to retain that invested capital, at the same time making it easier for investors to enter and exit their positions. That's where we're going to see the importance of the security token exchanges that we're going to talk about in Module 2. Not to mention, tokenization unlocks a global investor base, a global pool of liquidity. Again, tokenization also helps with the identity of ownership, who is owning the shares in a definitive sense. But the real transformative value of tokenization comes from all that liquidity that can come in and trade the underlying securities. And let's think about this from another perspective. When you're entertaining some SEC exemptions like Reg A, Reg D, or Reg CF, which we'll talk about later on in this class, there are certain obligations, there are certain things that the SEC is going to hold the issuer responsible for. They are regulating what happens with the stock that is issued. So if you're a real estate investment trust or some sort of private company, having too many or too few investors can be a big problem. Going under or over the required number of investors will result in you being forced to go public or having to pay millions of dollars in additional taxes. If you have too many investors, you might be forced to go public. If you have too few investors, you may lose your tax status. This is why we see private securities often trade at a huge discount, because by virtue, there's no real secondary markets for them. This is known as the illiquidity discount. So security tokens solve the inefficiencies with the current infrastructure. For issuers, it also solves the liquidity problem. This isn't about turning the shares of your company, the equity of your company, into something like Bitcoin. All the normal laws will still apply, and all the normal regulations will also still apply. But I want to make sure that you understand that when you entertain tokenization of equity, you're not going to decentralize a company. Big companies like Apple are centralized. They have an office, they have a CEO, they have stores you can go and visit. That's always going to be centralized, at least for the foreseeable future. Maybe in a century or so, we'll have everything in virtual reality, so that won't be an issue anymore. But for the time being, general corporate law, the general world, and the general economy are centralized. So tokenization is not solving that issue. You're not solving for some sort of big database. What tokenization is solving is the custody of how equities, how stocks, how bonds are actually held around the world. In a lot of cases, it's very complex, messy, and has a lot of layers that don't make any sense and don't need to be there. There's a lot of inefficiency. I mean, think about it. How long does it take for bank-to-bank ACH transactions? Usually a couple days. They're starting to get better about that, but really that's just some magic that they're working on the front end to make it look like it's taking a lot less time than it actually is. Compare this to trading. You know, Wall Street is very good at that. They can move millions of shares in a second, but trading is very different than settlement. Wall Street is not actually moving the money. It's sort of like an off-chain transaction. So this is where tokenization will really help, because it will make it more efficient to move securities around, to enable settlement on a much faster scale. So what's great is not only will you get the global liquidity on tokenized securities, you'll be able to ensure that they're trading compliantly no matter where they are 24/7, 365 days a year around the globe. And understand that compliance is a big factor of that. Compliance cannot be trustless. Once compliance is enabled, once it's provided, then the rest of the system can be trustless. That enables you to have a system where the buyer and seller can trade 24/7, 365 days a year, instantaneously with no counterparty risk. So again, going back to understanding where security tokens are coming from, it's fundamentally looking for areas where you want to lock up the capital, but not the investor. Security tokens represent ownership claims in all things that you normally think of as investment vehicles. Stocks, bonds, treasury notes. And just like I said at the beginning of this class, only a third of the world's wealth is in cash. Like I said, Bitcoin is going after that, trying to become, I guess, the world's new reserve currency. But again, it's only 30% of the world's wealth. We need to give people the same kind of power for their equities. We're looking at a market of 256 trillion in real-world assets that have yet to be tokenized. So let's close out this module by talking about broadly what are the benefits of security tokens. I mean, first and foremost, we're talking about raising capital on a global level. Going back to our example of Kickstarter, this is just like that, but on a global scale. People from around the world can invest in projects and assets that they feel inspired by, regardless of their location. This in turn increases liquidity. Having fractional ownership through tokenization of assets allows you to speed up transactions and improve liquidity, allowing you to touch a market that has been rather untouched by technology. To that end, you also have the benefit of fractional ownership. Having the ability to buy $10 worth of a building is something that we just currently can't imagine. But with fractionalized ownership, we can see a world where people can truly diversify into many different asset classes and do so in a way that is structurally beneficial to the overall economy. Speaking of beneficial, we also eliminate the risks of scams and fraud because STOs are going to deal with the same regulations that we're used to. These are time-tested and battle-worn regulations that are meant to protect the individual investor. You'll also see benefits for the companies and issuers, mainly cost reduction. An initial public offering, an IPO, is going to cost millions of dollars and some of the equity of the underlying company. But with an STO, you can do it much faster and for much cheaper. And I think that is going to be very compelling for companies looking to raise capital. Finally, I think there's a benefit of working with crypto. I see STOs as a complementary sector to cryptocurrency, where the benefits and developments of one is going to benefit the other. STOs are enabled by blockchain technology, but they are not cryptocurrencies. However, the developments, the utilization, and the proliferation of STOs will bring attention to blockchain technology and get more people to understand the benefits, the realization of what blockchain is. I mean, certainly as we saw the backlash of the ICO market, where many projects turned out to be frauds, many people were scammed out of their money, I think STOs are the natural response to that, where we're going to see many benefits for the individual investor. Now, there's plenty of work left to do, but the security token movement has substantial momentum at this point. I think the hype around blockchain will help add fuel to this momentum, but only the realization of what the benefits are will help sustain it in the longer term. I think we'll see an absolute firestorm of tokenization happening in the next few years. And it's very exciting to be on the ground floor of that. There's simply too many benefits offered up to too many parties for it to be ignored. So thank you for joining me in this class. In the next module, we'll talk about security token exchanges and the importance that they'll play in helping this movement, this new sector, be realized. So I'll see you in the next video.